Investors are fleeing emerging market stocks at the fastest pace since 2015. So there's been a number of articles that have come out. I've been monitoring this now for a couple days, and there's been record-setting days just in the last about 7 days. There's been a couple of them of record capital outflows out of emerging market stocks. And I'll talk about why I think that is. I think there's at least a handful of major reasons. Part of it is trade war fears. There was a good Business Insider article, Markets Insider from Business Insider, that came out on August 9th of 2019 from Carmen Reinecke, if I pronounce her name correctly. And it's talking about emerging market equities saw their largest outflow since 2015 this week as U.S.-China trade tension spiked and concerns over global growth mounted. Latin America is the most exposed region because it trades heavily with China, according to analysts at the Bank of America, Merrill Lynch, and also JP Morgan. And the emerging market equity saw $6.2 billion of capital outflows, the biggest weekly total since 2015, according to data compiled by Bank of America Merrill Lynch. I have other articles that are citing other research from the Institute of International Finance, or IIF, where basically, I think within a single day, over $2 billion on August 5th came out of emerging market shares. And I think on August 2nd, I have another article up how over $1 billion came out of emerging market share stocks. So a lot of money is starting to flow out of emerging markets. And I think this is tied to not only trade wars with China, but also the data that we're seeing from the Chinese economy, that the real Chinese economy, the data is just not good. Whether that's exports, and what's confirming that also is the export data from South Korea, the export data from Taiwan, and the real economy in China, it's being hit very hard, in my opinion, with stagflation. So higher food prices, higher rent prices. The factory owners in China are not getting the prices that they thought. They're having to discount, or they're being stuck with lots of inventory. And a lot of emerging markets have hitched their wagon to China. The main export for a lot of these emerging markets, especially Latin America, is in a lot of instances to commodities. So base metals, commodities to China. Now, China has imported a lot more soybeans, I think, from Brazil. I think there was an 8% increase recently I saw in some data from imports of soybeans from Brazil. If you go back about a month and a half, I think I did a video talking about how Brazil might be one of the benefactors from agriculture. But in a lot of other instances, China is slowing down, especially with like energy imports lately and base metal imports. So the commodity prices for energy and base metals will slow down. I expect China to continue to import a lot more food all over the globe, although obviously with the trade war tensions rising with the U.S. and that escalating, they're not going to be importing from the U.S. So Brazil and Argentina and some of those other Latin American countries, their agriculture industries have a real major have a real major opportunity to take advantage of. So let me talk about some of the main reasons why I think emerging markets are going to come under a lot of pressure. There's going to be a lot more pain in emerging markets, especially for a lot of emerging market shares that are not in agriculture. So emerging markets, I've talked about this in the last couple weeks. According to the Bank of International Settlements, which tracks dollar-denominated debt from non-banking financial institutions, there's a record $11.8 trillion worth of dollar-denominated debt outstanding. And with the trade-weighted dollar index, and in the instances here, because the trade-weighted dollar index measures the U.S. dollar against more emerging market currencies, the trade-weighted dollar index, if you're not familiar with it, it's weighted against about at least 26 other currencies. The Federal Reserve created it, and they track it, and they update it about once a week. And the trade-weighted dollar index got, I think, as low as 115.5472 on January 31st of 2018, and it's had a very big rally since, and it's gotten really, really close a number of times in the last few months to breaking above those to all-time highs at 100. Breaking above all-time highs at over 130 on the trade-weighted dollar index. So that would obviously be more onerous and would obviously hurt emerging markets even more, especially those emerging market governments, emerging market banks, emerging market corporations, etc., that borrowed in dollars. And that number, that $11.8 trillion number from the Bank of International Settlements, that's not counting the bank debt that was borrowed in dollar denominated debt. So that's not counting the euro dollar market, any dollar denominated debt that was borrowed from banks in euro dollar. So the main reasons I think that the emerging markets will have trouble going forward are, number one, China slowing down. There's just a lot of evidence of this, that the Chinese economy is slowing down. Whether or not you believe the 6.2% GDP is irrelevant. A lot of the other data that's coming in from exporters from Hong Kong and Taiwan, the food price increases, the higher rent, the manufacturers in China having problems, all these other data points are showing that the Chinese economy is slowing. On top of, the other issues I've laid out in China with problems with the currency, potential real estate bubble collapsing in the near future, problems. I've heard anecdotally of a lot of people in China are having problems trying to sell their real estate now. So all these things together, China's slowing down, and that hurts emerging markets because a lot of emerging markets have hitched their wagon to China. That has been the main export customer for a lot of emerging markets lately. So China would be one of the main reasons. The other one would be a stronger dollar and the dollar denominated debt that is borrowed. So that would be number two. Number three, I talked about this earlier in the show, capital outflows. So capital outflows can do a lot more damage than you might think. And this is why countries like China have capital controls, because they're worried about capital outflows. They do not want mass exodus of capital leaving their country. So they don't want tens of billions or $100 billion leaving the country in a very short amount of time. That would be China's example. In other countries, they do this, at least in the past, they used to do this. One of the best first of all, if you're not familiar with capital outflows, I should probably just read a definition of what it is, because I know we have a lot of new listeners here who are just getting started. People are just finding my channel now because it's starting to grow rapidly again, and people who don't know what capital outflows is. So the definition, I'll read a couple definitions on a couple different financial websites. This one's from investorwords.com. A net flow of capital, real and or financial, out of a country in the form of reduced holdings of domestic assets by foreigners and or increased holdings of foreign assets by domestic residents, recorded as negative or a debit in the balance on capital account. So that's from Investor Words. The Investopedia definition, capital outflow is the movement of assets out of a country. Capital outflow is considered undesirable as it is often the result of political or economic instability. The flight of assets occurs when foreign and domestic investors sell off their holdings in a particular country because of perceived weakness in the nation's economy and the belief that better opportunities exist abound. Or it's flight capital. People are retreating because they expect a financial crisis. They're retreating to what they view as safer things. They're going to dollars. They're going to treasuries. We see this in the market. We see this in price action. Look at the yields on treasuries going down, on U.S. treasuries going down. That means more flight capital is coming out of elsewhere, other countries. Maybe it's Europe, maybe it's China, maybe it's emerging markets, or a combination of those things, because on a relative basis, U.S. treasuries still have positive yield. So even though yield has come down on the yield curve in treasuries, even though the yield on the 10-year U.S. Treasury is down a lot. I think it was at 2.78% in sometime last year. It might have been October. I said this yesterday or the day before. And now it's down to 1.7 something. That's still on a relative basis. Remember, things are relative now more than absolute. People are looking for relative returns, what's relatively safe, what has a relative yield, etc. And that's why I think a lot of capital is leaving emerging markets, especially emerging market stocks. It appears there's still demand for some emerging market bonds, shockingly. And that's why you have some of these emerging market countries like Argentina, I think, issued, a 100-year bond that's paying 7%. And there was actually demand for that, which is just ridiculous. I wouldn't trust the Argentinian government. And speaking of the Argentinian government about that, I wouldn't trust them investing for 100 years in a bond at only 7%. You're not even going to be alive at the end of the bond. But speaking of Argentina, one of the best case study examples for capital outflows and capital controls is what happened to Argentina in the 1990s. So I've heard stories about this from people from Argentina in person. I met some people from Argentina, and I've spoken to Argentinian listeners, and I've listened to podcasts from people who survived this in Argentina. And there was a lot of craziness going on in Argentina back then. I think they were running a dollar peg, but they were also running enormous current account deficits, and they were running budget deficits, and they were printing their currency a lot in spite of the dollar peg, I believe. And a lot of people realized that there was going to, inside Argentina, and investors, foreign investors in Argentina, realized that there was going to be problems with the Argentinian economy, and they tried to take capital, their savings, out of Argentina, out of the Argentinian peso. And I believe what the Argentina government did was they froze bank accounts, and they put in enormous capital controls to try to prevent the capital outflows. So what stories from what I've heard anecdotally from people is that people who had US dollars in Argentina bank accounts back then, and this was as Argentina's hyperinflation, and Argentina's had a lot of these hyperinflations over the years, but this was like the 1990s one. And as Argentina's inflation was getting worse, the Argentina government in bank accounts there in Argentina, they were putting in capital controls. They were trying to prevent capital outflow out of the country, a mass exodus of capital, and they confiscated the US dollars. So if you had a bank account back then in Argentina and you had some of your savings or capital in US dollars and some in Argentinian pesos, what the government did back then, and this scared a lot of people, pissed off a lot of people, and this actually increased the amount of distrust in the government, is the dollars, the US dollars in the bank accounts in Argentina were actually confiscated, and then because I guess the government needed them, and then you were forced into Argentinian pesos, which were being rapidly devalued relative to the dollar. So emerging markets now, they're very cognizant of that. I believe the Asian tiger crisis of the 80s, the Asian tiger crisis of the 80s and 90s, early 90s. The Asian tiger crisis of the 90s also had a large capital outflow component. I know we have a lot of former financial professionals listen to this podcast. I'll see if I can find some articles with some good stories talking about capital outflows from the Asian tiger crisis. But I know the Argentina capital outflow story better than the Asian tiger crisis. So this is why governments like China have enormous capital controls, and other governments have some form of capital controls. I think the most draconian capital control right now is in China. So you have a combination, a bad combination. This is a lot of headwinds now for the emerging markets. You have the main exporter client for a lot of emerging markets is China. You have China slowing down a lot. You have onerous amounts of dollar-denominated debt, plus in the trade-weighted dollar is strong, and it could break out to all-time highs above the 130 level. You have net capital outflows. You have net capital outflows in China, too. So there was a brief amount of capital inflows, I think, in June or July for China, but overall, if you look at the capital outflows, there's a lot of net capital outflows in China. So there are a lot of net capital outflows, whether it's stocks in emerging markets or stocks in China, a lot of net capital outflows in general. And then when you combine these factors, it just does not look good for emerging markets, and in low commodity prices too, especially in energy and base metals. Most emerging market companies are liars, Andy says. Yeah, Andy, I mean, with the accounting, it's very tough to verify. And the other problem is a lot of these mutual funds that are recommending emerging market stocks, you have to find out if the emerging market mutual fund is actually going to the company and checking on the assets, because you don't want a China hustle situation. And if you have not done so, I highly recommend watching the China hustle documentary. And this is more common, I would say, in a lot of emerging markets, because if you did this in the US, if you tried to do this with totally fraudulent assets, you're going to prison for a long time. So every once in a while, you hear stories of a mimetics, and props to Mark Cahodes for bringing that to light. But that amount of egregious fraud is nowhere near as common as levels of frauds in emerging markets, especially in China. Now, there's different types of fraud here in the US. A lot of the fraud here in the US is very, very aggressive accounting, and it really pushes the envelope. It's technically not fraud. So if you spoke to a corporate lawyer from a lot of these companies, or a corporate lawyer with a lot of experience who used to work for companies and no longer does and is going to be more honest, they would say technically, or someone like Francine McKenna, who I've interviewed, she would say technically it's not accounting fraud. She would just call it very, very aggressive accounting. Same thing with some of my hedge fund manager contacts who short frauds. So they would say it's technically not accounting fraud here in the US, but it really pushes the envelope. There's like a gray line, and the lawyers, a lot of these lawyers are paid, corporate lawyers are paid a lot of money to push it right up to the line. Same thing with the chief financial officers. Now, there are egregious accounting frauds here in the US, but they're not quite as pervasive, I would say, as in a lot of emerging markets. In general, though, accounting is nowhere near as honest as it should be. I would like to see more transparency there. The mining industry has problems. So there's three main reasons. Hey, thanks, Greg, for the super chat. I appreciate it. There's three main reasons why emerging markets are going to have a lot of headwinds, and they're going to come under a lot of pressure. And that's slowing China. That is too much dollar-denominated debt. There's also a lot of debt in local currencies in these emerging markets. But they may be able to print that away, or at least attempt to print that away. But the dollar-denominated debt is the problem, as I've tried to explain at length with the China situation, because there is a lot of dollar-denominated debt in China, and the People's Bank of China, their central bank, cannot print that away. And the same thing holds true for dollar-denominated debt in other emerging market countries. So you have slowing China, dollar-denominated debt, plus the stronger dollar. It hasn't weakened yet, and the dollar might not even weaken even if QE, because on a relative basis, the U.S. still appears in better position than a lot of the emerging markets, than the European Union, etc. And then you have capital outflows, and there's a long history of emerging markets trying to prevent capital outflows, as I've said, whether it was the Asian tiger crisis of the 90s, early to mid 90s, I believe, and then the main example that people talk about with capital outflows and how a government can handle it wrong is Argentina. So do I think we are going into a depression like Peter Schiff thinks? It's a question of when and not if, but the rules are going to be changed, and the governments are going to try to cheat and change the rules. And we're in stagflate and tax and lie mode now, and pretty much all the governments are lying to one degree or another about the economic data now. And the lies are probably going to get even crazier and even worse. I think we're in stagflation now. There's a lot of jobs cuts in the U.S. with retail. So this quote-unquote greatest economy ever from Trump, the real-world evidence, the boots-on-the-ground stuff, like Lowe's and so many other retail stores in the U.S. are firing people left and right, cutting. There has been some wage growth, but not everyone is getting it, and I think the wage growth is at most like 4% wage growth. Meanwhile, everyone's getting killed. If you look at the Chapwood Inflation Index, which I've been promoting longer than anyone in the gold community and the alternative media, I've been talking about that for 7 or 8 years, for a long time. And the Chapwood Inflation Index is saying that your real-world inflation is between 8 and 13% in every major U.S. city. So that's just really horrible stagflation. That's per year. So if you live in one of the major metro areas like Washington, D.C. metro area, or New York City, or San Francisco, San Jose, Silicon Valley area, you're getting killed a lot more than in Houston or somewhere in the Midwest or somewhere in the South with inflation. But overall, inflation is very, very high. Time for emerging markets to shine? No, I think emerging markets are going to have a bust, man. They've borrowed way too much dollar-denominated debt. So unless the dollar starts to really, really fall, that dollar-denominated debt is going to become very, very onerous. And the central banks and the governments cannot really handle the dollar-denominated debt unless they have a lot of dollar reserves. They're running a trade surplus. They're collecting dollars. They have a lot of dollar reserves. For example, China claims to have $3 trillion in total reserves now, but a lot of it is, depending upon which source you believe. I covered this in my extensive China video that I spent over 8 hours working on Monday. That either all that $3 trillion is tied up in collateral, so it's not liquid. They can't sell it immediately to pay off their dollar-denominated debt. Or if you believe Kyle Bass, they have nowhere near the $3 trillion. It might even be below $2 trillion now, which means that there's a lot of projects like Belt and Road Initiative and others that China's not going to be able to pay for immediately. There's a lot of 5G projects that China's holding off on. I don't think they're going to be able to pay for everything too. Terror Optic Studios, thank you for all your hard work. I'm glad you appreciate it, man. I've actually gotten a ton of Patreon contributors, new ones in the last few days. So I think it's like almost 10 now. I've gotten 10 new ones in just the last couple days. So thank you. There was, prior to that, there was a lot of people who were telling me, listen to the podcast. I guess I didn't promote it enough that I had a Patreon. A lot of people didn't even know I had one. But I have I think almost 80 Patreon contributors now. It might be over 80 now. So it's starting to get up there. I thought I would have gotten it a long time ago, but I'm just grinding and hustling. I've been focusing on trying to get something out every day or almost every day. For the last 2 months straight, I think I've taken 1 or 2 days off at most. So I've been really working on trying to get a really good piece of content out for you guys almost every day. I sent out some emails trying to get a shale oil expert on. I sent an email to Art Berman last night, so we'll see if I can get him on this week. I'm working on some other stuff too. But the base metal prices, the base metal miners, and the shale oil companies, the U.S. shale oil companies, those charts, those markets, the oil price does not look good. And that would reflect that weakness in China. It would reflect weakness in the global economy. And that is not good for emerging markets. Weak base metal prices and weak energy prices. Now, some companies in emerging markets will benefit from China keep the trade war and China not buying soybeans from the U.S. and other agricultural products. So there will be a lot of opportunities there. I talked about this about a month and a half ago. China has secured all raw materials for electric vehicles, nickel, cobalt, lithium. US and EU have nil. Also rare earths. There's a lot of lithium though, man. Joe, there's a lot of lithium. Lithium is not rare. There's a ton of lithium. There's a lot of lithium deposits in Argentina and Chile. So, for an example of an emerging market that could have a problem, Chile could be one of them. Speaking of Chile, Chile has a lot of copper production, and I remember talking last year about how they were talking about increasing copper production by 4%. Well, the base metal markets and copper prices, base metal markets other than maybe nickel and palladium, are not doing well at all. And so Chile wanting to increase copper production in a declining market where demand from China could slow down doesn't sound that good. Chile also has a fair amount of dollar-denominated debt, so they could come under some pressure. And the reason a lot of countries decided to borrow in dollar-denominated debt, as I've stated many times, is that they were betting that the dollar would be weak, and that in the short term, the interest rate payments were lower in the dollar-denominated debt. So they were gambling that their currency would appreciate against the dollar and that they would have to pay less interest payments. But when the dollar rallies, all those plans go upside. Well, I'm trying to think of a polite word to say this. They get destroyed. Those good plans get totally ruined very, very quickly. Tom, send me the link. China Unscripted. Person living in China for 9 years. China Unscripted is their other show, right? Besides China Uncensored. I'll take a look at that later. Thanks for the super chat, Blue Steel. Hey, Sean, I never said that Taiwan's food prices are rising. I'm saying Taiwan's export data is not good. If you look at Taiwan's export data, it's not as good. Same thing with South Korean export data. This shows that the global economy is slowing down a lot. So I wasn't talking about food price increases in Taiwan. I was talking about Taiwan's export data. Same thing with South Korea, same thing with Germany. Japan's export data is slowing down. A lot of there's very little positive export data, if any. I was merely using Argentina as an example for how to screw up with capital controls and capital outflows, and there was massive amounts of capital outflows, and then the government overreacted, and people lost total faith in the government, and for many years there was very little, if any, foreign direct investment into Argentina. That was the point I was making. So governments, when things go really bad, the capital outflow is an economic term. I'm just going to read the Wikipedia part. Capital outflow is an economic term describing capital flowing out of or leaving a particular economy. Outflowing capital can be caused by a number of economic or political reasons, but can often originate from instability in either sphere. Regardless of cause, capital outflow is generally perceived as always undesirable, and many countries create laws to restrict the movement of capital out of the nation's borders, called capital controls. While this can aid in temporary growth, it often causes more economic problems than it helps. So this actually, it makes people lose faith in the government to not allow capital to move back and forth. So there's a balance that the government tries to, normally an emerging market, tries to obtain by having some type of capital controls or capital restrictions preventing outflow. But if they do it wrong, it turns into Argentina experienced rampant and sudden capital outflows in the 90s. After its currency underwent dramatic pressure to adjust in light of the fix. Argentina was running a dollar peg, but it was they were pretending that they had good monetary policy by running a dollar peg, but behind the scenes they were running twin deficits, current account deficit, and budget deficits, and a bunch of other stuff. A bunch of other problems. So massive capital outflow is usually a sign of a greater problem, not the problem itself. So capital outflow, what I would say, capital outflow from emerging markets, especially in emerging market stocks, is that people are going defensive now into dollar, treasuries, gold, more so, and there more capital still going into the US that people would rather speculate on some of these garbage unicorn bubble stocks in the US. Like, I think WeWork is going IPO soon, so that's going to be another bubble stock, even though I've heard from a lot of people that their WeWork rentals in New York City and London are having enormous problems, but they're going to dump that. This is not financial advice, just my opinion. They're going to dump that onto the public markets, and for a short amount of time before the lockup period expires, that IPO is going to go up a lot, and then eventually after the lockup period and the insiders have dumped a lot of their shares, almost all their shares, that stock will probably crash. Countries with outflow restrictions can find it harder to attract capital inflows because firms know if an opportunity goes sour, they won't be able to recover much of their investment. Governments that institute capital controls inevitably send a signal to their citizens that something might be wrong with the economy, even if the laws are merely a precautionary measure. So this is directly from Wikipedia. China runs enormous capital controls. So the people who are pro-China, I mean, China's kind of, I was just thinking of the right way to explain this. So China loves to bring in gold. So that is obviously a good sign for them that they're increasing reserves in gold. But a lot of their other capital, they have enormous restrictions on. So people inside China, they don't want people inside China taking out their money unless they're in the government and they know how to get around the rules. Or, bribes and corruption. It's just, China has a lot of, despite the gold imports, China has a lot of net capital outflows now. I think that's the best way to describe things, that they have just an enormous amount of net capital outflows. So in spite of all the gold that they've been buying, they have net capital outflows, which is another red flag. So like people in the gold community, people in the alternative media, China's going to collapse the dollar because they're buying lots of physical gold. They don't talk about the other side of the coin, that China has lots of net capital outflows. So even though China's buying gold, they have net capital outflows. You don't hear, I've read a lot of pieces by people in the gold community, and I've never heard that once. And I've been in the gold community for 10 years reading articles and podcasts. Nope, I have not read that book, The 100-Year Marathon. It's about, you say it's about their long con and pretty good. The big money fund, Joe says the big money funds will flow to mining companies. Maybe. The money's going into gold miners now. So the money we're seeing with price action, the money's going into silver miners. By the way, guys, this was not financial advice, but remember I was talking about how Pan American Silver was very cheap, around $10 a share in May. Now it's at 17. So in only like three months or so, only about 3 months, it's from about $10 a share up to 17 Pan American Silver. So there is more money flowing into the larger miners first. I don't know ultimately, though, how much money will go into some of these mining companies. The smaller ones, only so much money can go into there. Their shares are not liquid. I think a lot more money will go into the ETFs, the mining stock ETFs. Yeah, I don't expect credit card companies to forgive all the debt. Joe, I think the gold mining companies and some of the silver miners like Pan American Silver and First Majestic, I think they're benefiting from money leaving emerging markets and leaving other markets. So leaving emerging market stocks, leaving maybe oil company stocks, maybe leaving base metal miners. I think the gold companies are benefiting. I remember I talked about this divergence last week, how there was a big divergence between precious metal miners and oil, the oil price, and it's only happened 3 times since 1983. And normally it's a very bad omen. So I think money is leaving oil. I think money is leaving base metals. I think China's demand for agriculture and food and commodities will still be very strong, but their demand for oil, probably energy stuff, and base metals will probably slow down. There's a lot. I respect Nolan Watson. I think he's the smartest CEO in the gold industry. And one of the few things I disagree with him about a lot is the copper market, because on basically all of the copper market research reports I've seen, they all just assume on the demand side that China's demand will not fall and it will either keep increasing or stay the same. There's not a single investment bank or paid newsletter writer, any of the research reports I've seen, that is willing to make any assumptions that the Chinese demand for copper will fall. Not a single one. I have not seen one. And I've seen at least 8 research reports on copper in the last like 5 or 6 years, and I have not seen a single one with any assumptions that Chinese demand for copper could fall. And when I bring it up, people say, you're wrong. You don't know what you're talking about. But why are all the research reports all predicting the same stuff? I think it's confirmation bias. And I think no one's willing to stick. When you have one of those cushy investment bank research analyst jobs, if you stick your neck out and say that Chinese copper demand is going to be a lot different than the other research reports, you're risking your career. You're risking your job. So even if you're right, even if you make people a lot of money, you still have career risk. You could still get fired. And I think that's the case there, why no one's willing to stick their neck out. Because I've spoken with some of these guys off the record. They're like, you have some valid points that Chinese copper demand could fall, but I can't put in my report. How easy do you think it is to finance $1 billion mine in the current market? Almost impossible. It has to be a really, really good mine. It has to be a large miner with a good balance sheet and cash flow. If it's a new miner, the very few new mines are getting funded. The only one that got good funding was Lundin Gold's Fruta del Norte. There are very few new gold mines that are getting funded. Very, very few. The project economics have to be really good. It cannot be marginal. So we're not there yet. Right now, I have not seen any of the miners, primary gold miners with bad balance sheets, the producing ones with bad balance sheets, go to the market yet and raise over $100 million, $200 million to fix their balance sheets. We have not seen that yet. Now, after we see stuff like that, maybe then we'll see the miners' ability to start raising and raising more capital and building more mines. But right now, a lot of the miners are still, they need to fix their balance sheets. Let's put it that way. There's been smaller capital raises. There's been capital raises under a good amount of them under 70 million, between a couple $1,000,000 for a junior to drill and 70 million, but there has not been a massive capital raises yet to my knowledge. The best new gold mine that looks like it's coming online is Lundin Gold's Fruta del Norte mine in Ecuador. Ecuador has a lot of mining companies there now. There's a lot of exploration upside, and that mine has 8 grams per ton, and the construction is over 70% done. The mine's supposed to start ramping up production in October. So that mine, after the operating cash flow from the mine is reinvested into exploration, that mine could find a lot more gold at very high grade. 8 grams per ton nowadays is very rare for the entire average grades of the life of the mine for 11-year reserves. It's very, very rare. 10, 20 years ago, it used to be a lot more common. Nowadays, it's very rare. We're scraping the bottom of the barrel for a lot of onshore gold deposits. And then if you find gold that's higher grade, normally it's out in the middle of nowhere, and then there's no infrastructure, and then you have to build power lines and all this other infrastructure, and you're looking at, normally, if it's a big gold mine producing like at least 200,000 ounces per year of gold, you're looking at like probably well over $1 billion in capex just to build the mine before you start getting any cash flow. I also think that the corporations, this is an interesting comment here. Wall Street abandoned the U.S. to make China great. Now they want to come back. All is forgiven. Now that they have imperiled the U.S. Western security. I think the corporations thought that they could get more earnings and better margins by offshoring a lot of jobs to China. They also didn't want to pay American workers a higher wage and wage increases and, benefits and all those things. But I'm not sure if the corporations understood that they were going to have to do forced technology transfer in China, that they were going to have a Chinese partner in a lot of instances, that the Chinese government was going to force them to, and then also the Chinese government and other Chinese corporations would steal intellectual property. There would be massive amounts of corporate espionage, and then there would be theft of research and development and other stuff. So in actuality, a lot of corporations that moved to China, they did get the earnings per share announcements on their stocks, some of them, but the net effect of that, because they had to give up their technology transfer and they had IP theft and all that, and they had ridiculous amounts of competition in China. I mean, look at all the car companies in China now. General Motors probably thought that they were going to have dominant market share for a long time, and now look at all the competition in China for car companies. Now, the quality of cars, a lot of more affluent people in China prefer non-Chinese car companies, because it's a sign that you are more affluent if you buy like an American car, or you buy a German car, or you buy like a Toyota or something. But in general, I would think that a lot of American corporations and European corporations did not get as good a deal as they thought when they built factories in China, made investments in China. And some of my contacts in China, they want out. So they've lived in China for a decade or more. One of my contacts who lived in China for a very long time, I just saw on his Twitter that he moved to Miami. So he didn't tell me he left, I guess, not too long ago. He had worked at the General Motors plant. He moved from Michigan to China, and he learned Mandarin, and he was one of the main managers helping open up the first General Motors plant in China. And he was there a very long time with other jobs, a lot of connections in China, and he just left. So there are a lot of Americans and foreigners who are leaving China recently, and business people who own businesses leaving China, and also people who are inside China who want to leave soon. Some of them have real estate investments and can't get out, though. They haven't sold their real estate investments yet. So I think to summarize this show, and I have articles if you want to go more in depth on this, but I think emerging markets have a lot of headwinds. There's at least three big ones. There's at least three big ones. There's probably even more than that if I sat down and wrote a list. So not all emerging market companies are going to be in trouble. I think emerging market agriculture companies are actually going to benefit a lot from this escalating U.S. versus China trade war. So I think our agricultural companies like in Argentina and Chile and Brazil, if they can actually execute their business plans, because some of these agricultural companies in Latin America have really difficult problems with infrastructure and executing their business plan. They have just not lived up to expectations. A company like Cresud in Argentina, which has a lot of farmland in Argentina and Brazil, and I think also Chile, and they have not lived up to their business plan. They've been a disappointment, I think, on their share price for many, many years. I remember people recommending them when I was just getting started in finance, saying that it was a good play for China, and the stock really hasn't done nearly as well as people predicted years ago. But my educated guess is that companies like that will probably benefit from what China is deciding to do against the U.S. with the trade war and not buy soybeans and other agricultural products. Joe, the big funds, so most people aren't aware of this, but all the mining companies, the gold mining companies altogether, not a large amount. Their market caps are not that large. So all these funds cannot go into gold. They cannot go into gold miners. Okay, all these big funds that are tens of billions, hundreds of billions, there's just not enough gold mining stocks without drastically driving up the price like crazy. Now they can get gold exposure. What they will probably do, unfortunately, is go into GLD. I think that's stupid, but GLD is very liquid. So these conventional generalist hedge fund traders and professional money managers, to get gold exposure, they will probably go into more conventional gold investment products. Okay, guys, well, that's it for today. I'll talk to you guys later. Bye.